let's get into our recap for last time, if my clicker will decide to work for me, please. There we go. Okay, so last time we were together, we started our conversation about how we like to build our new portfolios, a lot of the different concepts that we like to use in how we kind of give ourselves a guideline on how we're going to start building our portfolios, choosing our investments, and how we start structuring them. So today we're going to dive a little bit deeper into that structuring and how exactly you can pick these different funds and layer them around to build a portfolio. And a little bit later, in a later class, we'll actually build one together. So we started talking about what I call new portfolio construction theory, and we started talking about how we can use time to help us select our investments, and how that's really kind of the basis that you want to use when you're choosing investments. Because again, those riskier assets, you need more time for them to show their worth, and those more stable assets can be used for those more immediate needs. So like I mentioned, the longer we have, the more risk we can take because we can allow those averages to start to play out. The stronger our liquidity needs are, the more cash we need at any given moment, the less risk we can take at any given time. And then we also saw how you can sort of split that up into different sections. So you can have something provide for liquidity needs as well as have something else provide for the long-term growth. We talked about the law of large numbers, which is basically the statistic that sort of justifies our willingness to sit through volatility for longer-term investments, and why you may not want to always cut your losers immediately when you start seeing some red, and why you might hold that for longer. As we get more and more of that data, the measurements of that data start closer to what we expect from our historical analysis. And we talked about how we would use that information, how we would use time to give us the data for those averages to start playing out on those risky assets, and how we would use more stable things like cash and cash equivalents for needs today or tomorrow or within the next year or so. We talked about how we would diversify away the risks that we can get rid of, so that we're only dealing with things like market risk and interest rate risk and those sorts of things. We discussed dollar cost averaging a little bit as a really easy way to sort of, without looking, get your cost of shares down over time, especially in a volatile market. And we talked about the different ways that we would split up our allocations when we're using time. Stuff like cash for short term, bonds for intermediate term, and longer term for stocks. Now this isn't really a be-all end-all allocation. This is just the easiest way to sort of conceptualize it. Generally, we're using a mixture of all of these different assets in all of these different categories for the most part, and we'll take a look at some of that today. We talked about diversification. So now that we've gone horizontally or laterally in our portfolio for time, we also talked about how we can start to get spread out vertically, and how we can go between different asset types, and what kind of risks we're trying to mitigate by doing so instead of being all concentrated in one asset. And we talked about the types of risks that we have. So we have our systematic risk, which is what we're using lateral integration to manage. And we have our unsystematic risk, which is what we're using our diversification to get rid of. All of these risks down to a level that's pretty much zero and doesn't impact you. Obviously, even if you have 1 million companies and one fails, that's 1/1,000,000th of your portfolio gone, but it gets to such a small level that it's not going to impact your rate of success in the future as much as if you had a very concentrated portfolio. So today we're going to discuss both of these concepts in a little bit more detail, give you a little bit more clarity on what they actually mean and how you put them into practice, and different types of investors. So a couple profiles that might match you. We're not going to go through every single profile, risk profile that an investor may have, but we'll look at a couple different examples so you can see possibly where you might fit in within those different ideas. So firstly, we're looking at lateral and vertical integration concepts in a practical sense. Last time we talked very conceptually, and we didn't really get to picking a specific thing at any given time. We didn't give too many examples of different funds or assets that you might use, but today we'll start to dig into that a little bit more. Lateral integration in the big picture is one thing I want to touch on before we get too far in, because when we've been talking about one portfolio in isolation, usually kind of thinking about a 401k or an IRA. But really, when we're talking about lateral integration, you can think about that across your entire financial picture. Because obviously, a retirement account is the easiest way for me to communicate this idea, because when you have required minimum distributions, that's your cash need. But if you have beneficiaries, there's your growth need. It's very easy to connect those dots. But if you're looking in the bigger picture, these concepts can be used in a more broad sense. So if you have significant cash reserves in your bank account, and then you also have an investment account, you might not necessarily need to have a lot of cash reserves in that investment account, because now you're doubling up on cash. So if you already are somebody who holds a lot of cash in your account and in your bank accounts, and your investment account does not need to pay for anything itself, say it's a non-qualified account, there's no required distributions, you're not using it for any particular purpose, you might not need to have that immediate stage 1 allocation at all. Yeah.
So, in your opinion, what's a safe amount of cash to have?
I think that kind of depends both on stage of life and expectations of what your expenses are going to be. But if we're looking at the total general, in retirement, the general overall in terms of whole life is between 3 to 6 months of expenses. I would probably be biased towards that higher end, especially in retirement, just because you're not in your earning years anymore. You're not stacking any more capital. You're not growing investment accounts for the most part. But I would be between that 3 to 6 months. And if we're looking at investment accounts, again, kind of tying back to that retirement account, I like to think of maybe I have a year or two worth of distributions stacked up at any given time. So I have this year's distribution that I'm able to pay out, but I'm also already prepared for next year, so that if there's some kind of significant change in my assets or how the stock market moves, I'm not at the mercy of that movement for my next distribution. So I kind of like to always be one step ahead of whatever the cash need is. So if you can always think 1 year in advance or 2 years in advance, whatever makes you feel comfortable. But for me, I'd like to have 1 to 2 years, preferably 2, in cash distributions on a retirement account. And you can kind of take that idea and spread it across to other ideas and sort of get to where you're comfortable. But I always want to be able to be one step ahead. So whatever if something happens today, I need to be able to finance that again next year or within the next couple years, just so that you don't run into one expense that drains you to zero, and now you're stuck with nothing there, and you have to pull from assets that are falling. So an investment account can be one stage in the overall portfolio. Your portfolio could consist of a lot of cash at a bank account and a savings account, and then stocks in an investment account, and you might have real estate, you might have a personal business. All of these things are pieces of your overall portfolio. Your portfolio doesn't just have to be an investment account. And in fact, something that we do that's a little interesting every once in a while is if you are a person that is getting a large pension, we like to think of that somewhat like a bond or somewhat like a cash reserve, because you're not necessarily at risk of that asset going up and down. You're getting a guaranteed payout for lifetime or whatever the set period is. And we can kind of think of that and go, okay, so if we look at these cash flows, what are these worth? Do a couple fun financial calculations and think of that as one piece of your portfolio. So if you have a big pension and a big investment account, you might not necessarily need to tailor that investment account for your safety if your pension is already paying decent income. You might not need that portfolio to be income focused. You could have it more focused on growth, whether that's for beneficiaries later or if that's for another purpose down the line. Obviously, we don't want to get too drastically overextended in our investments and now be relying on the pension for every need, but it's something you can consider and you can adjust if that makes sense to you. So knowing the purpose of the account gives us the framework to build a proper portfolio. So if we're thinking that our investment account is stage 1, then I'm going to allocate that to mostly cash, short-term bonds, maybe a little bit of extra longer-term bonds or lower credit quality. But if I know that this investment portfolio is meant to be left to a child that has 40 years left until they receive it, I'm not going to put it in bonds and stock, or not bonds and cash. I'm going to put it in mostly stocks, if not all stocks. Very aggressive investments, because I've got plenty of time on my side and I have time to readjust as we go forward. So in today's class, the purpose of the portfolios will be assumed to be retirement or required minimum distributions. just because, like I said, that's the easiest way to communicate each of these ideas, because they can all tie directly to a purpose of that individual retirement account or 401k or whatever the case may be. So we'll talk about a couple examples for time-based investing. We talked conceptually, now we'll talk a little more practically. And these are kind of examples for a standard balanced portfolio, kind of somebody right in the middle. Maybe you're 60-40 or 50-50 or 70-30, any of those sort of different amounts of equities versus fixed income or stocks versus bonds. So when we're looking at stage one, we're generally looking at a time period between 0 to 3 years. And we're looking for securities that can be liquidated quickly with little or no loss. So we're looking for stuff that if I need cash today, I sell today, and I'm not seeing a big fluctuation of price movement up and down. Because again, if I'm completely invested in an S&P 500 fund, I need cash at the end of the week, and through the week we have the worst week we've ever seen in the stock market. I'm probably not going to have quite the same amount of cash that I thought I was going to have when I go to withdraw. And it's possible I might not have enough to satisfy whatever need I'm looking at. So if I have a need in the next 0 to 3 years or some kind of distributions, I want to have something that doesn't lose a lot of value with volatility. But that also means we're giving up upside. So these are your least aggressive investments, stuff like cash equivalents, ultra short-term and short-term government bonds that aren't going to, again, fluctuate a lot. I see a lot of portfolios where they'll put long-term bonds for your sort of more stable investments, but as we've seen, when interest rates start to move a lot, those get really, really volatile. We saw long-term bonds absolutely crash off the face of the earth when interest rates started getting hiked really fast. And when it was hike after hike after hike, those bonds just kept going down and down and down. So it's important to understand the risks that come even with traditionally safe investments, knowing what can happen even if it might be unlikely. When we're looking at stage two for this balanced portfolio, we're looking at possibly some longer term debt and index funds. Those are generally our favorites. We like broad-based index funds, whether that's stock market or bond market. So these funds would suffer greater loss if we liquidate them than the funds in stage one, but they'll likely recover with some dividends reinvested over time. So generally we might be looking for some equities, might be really broad-based. I really like total market funds for things like this because generally they get much more diversified than, say, an S&P or a NASDAQ fund that can be very volatile. But these total market funds are their standard deviations are much lower. They don't go up and down quite as drastically as a lot of these other growth stock funds or S&P index funds or NASDAQ index funds or even Dow index funds. And again, these are things where you'd be likely recovering them with dividends reinvested over time. And that's another key to what I like picking for this, is those dividends. I love picking value funds when we get to more specific targeted investments for this stage, because if I am generating yield, that volatility that I'm also being subject to is a little less, it's a little less frustrating to deal with when I know I'm also possibly generating 2 to 3 to 4% off of those investments as well. So things like value funds or big large caps that are paying dividends are very useful in this situation. So you might be using intermediate term government bonds, high grade corporate debt. We're not jumping into junk bonds yet. We still want very, for the most part, stable investments that aren't flying up and down with the movement of interest rates. We're not subject to that default risk. We don't want our money that's going to be moving to our stage one to also be subject to a lot of those unsystematic risks that we could diversify away, or the credit risk. Low-cost broad market index funds, like I just mentioned, like big stuff, lots and lots of companies, total market equities, that sort of a thing. That's what I like using for this part. So in stage three, when we get to the longer term, this is where we're holding for those long-term investor goals and objectives. Lots of that growth where we don't even need to be looking at it for the next several years. This is where we're getting the most aggressive, and generally we're oriented for growth. So for the most part, we're looking for companies that going to expand in value, not necessarily that they're paying dividends right now, but that we expect that they're going to continue rising in value, possibly sectors that are growing. And these will be things like growth stock funds, long-term bonds. Because of those longer-term bonds, we can get that higher interest rate for the commitment. And especially if we're in an area where it's possible that interest rates could go down, we have a little bit of appreciation potential. Junk bond funds as well, we can take that extra risk, especially if there's good managers, because we have the time for those things to sort of equalize out. Not that we want to start buying super horribly rated companies and debt, because we don't want to subject ourselves to horrible default risk for no reason, but we can start getting closer to those double Bs and single B bonds that are paying a little bit higher of a rate. Speculative investments is what would also go in here. So if you have anything that you really just have that strong conviction on, but it's still really high risk, consider putting it in the part of your portfolio that has a lot of time. Because oftentimes new companies or new sectors can be very volatile in the beginning and will flatline for a while, but then given more time and given more maturity to grow in market share and size and just getting better as companies and as a sector, they can begin to grow. So consider putting your more speculative investments or possibly individual stocks in this part of your portfolio.
By new sectors, you mean like a new technology?
Sure. So when I mention sectors, I'm thinking about technology or energy or any of those more specific categories than just stocks or bonds. Really, just kind of like a piece of the market that is similar in its.
That didn't exist before?
Possibly, it's so. There's kind of two different ways you can go about it. You can go for the speculative, for the things that are new that have not existed before, or you can go to more cyclical sectors, things like energy or utilities that tend to sort of go up and down with the seasons. And if you see something that is particularly depressed, you can enter into that and ride it as we start to change cycles.
Do you think Bitcoin will enter a technology sector or remain a thematic investment on the side?
I think Bitcoin is going to stay as a thematic investment for a long time. I don't think that Bitcoin itself is going to be the thing that enters the technology realm. It's very difficult to explain in a short period of time, but Bitcoin really is more of an example of a technology that can exist, more of a framework for things that can be built in the future. And because it's just so speculative and its value is not necessarily based on its utility at the moment, I would not really be looking at that as a technology investment, more of a speculation.
Yeah, with Bitcoin, I mean, I don't see anyone out there investing saying, oh, this costs tons and tons of energy to create new Bitcoins. And if they're going to be a more liquid currency, they're going to have to create more Bitcoins, and that's going to be, thousands and hundreds of thousands of kilowatts of energy to do that. And that just seems impractical and a stupid thing for the environment to do.
Yeah, and the other area you may have some exposure to is NVIDIA, the stock that's going through the roof. That is probably in the technology sectors, probably.
Yeah, that's a technology stock.
Okay. And you're getting indirect connection with AI now, so that is taking off. That makes a little more sense, but it looks like Bitcoin will be a standalone, like you mentioned.
Yeah, so the thing about those things with crypto is Bitcoin is probably the least efficient but most popular example of cryptocurrency. Transactions can be slow, they can be expensive, and they cost a lot of energy, like you mentioned. However, there's a lot of smaller projects that are much more efficient, that cost a lot less energy. But the problem with these cryptocurrencies right now is simply one word: adoption. If it's not adopted, it's not going to matter. It could be the best thing in the world. If nobody uses it, who cares? It's not going to make a difference if it's not implemented anywhere in any new technologies. So at this point, we're seeing this big popularity of everything crypto, but we're not seeing a lot of implementation in real-world examples. A lot of development is happening, and they're making a lot of strides in that sector, but it's hard to, from an investment perspective, look at it because, one, we have so little historical data. I can't really make any calls of how trustworthy it is as an investment. But again, we just don't have it implemented into our technologies, into our financial markets in a regulated sense. So there's a lot of advancement to be made there before I start considering it as parts of these profiles. But if you want to be the expert, there's a lot of opportunity in it, but you really do have to be an expert because it's so unregulated and because there's so much going on. There's a lot of risk to you as an investor if you aren't the expert, and you might think you're.
There's not a lot of need to go find a technology sector fund if you own the S&P 500 or other total market funds, because they have the top 6 now, so they're called the Magnificent 6 or something. So you already have those positions, and you are to maybe diversify away from it as a risk.
Yeah, possibly. Tech funds have, or not tech funds, tech stocks have really just become the mainstay of our big indices, like our NASDAQ and our S&P 500. They just take up so much market share. It will be very, very common if you look at your investment portfolios, regardless if you're total market, S&P, you're almost always going to find some Apple and a decent amount of it. You'll always see that. I see a lot of portfolios where Apple is the top holding because it's just such a common company in these index funds, especially the S&P and NASDAQ, that you might see 7 different funds in your portfolio, but every single one of them has Apple. So, something to consider. So, each investor has different goals, clearly. Each of us has a different idea of what we're trying to do with our capital, with our investments, and what we're trying to achieve. For each of these different investors, there will be a different asset allocation that makes the most sense to them. So obviously, we look at simple examples. We look at balanced portfolios. We see basically cash, broad market indices and bonds, and then more specific stock investments. But depending on the person, all of those are subject to change. It's a great framework to work from, but the most important thing is what you're trying to do and what you're trying to accomplish. If you have your goals and you have your time horizon, those are the most important 2 things that matter for what you're trying to do with the portfolio. So each of these different sort of investor profiles, ideas of where you sit as an investor, both emotionally and financially, influence our choices for funds in each allocation. Let's start to look at some examples. We'll start with the very conservative investor. This might be somebody who's at retirement, has plenty of money, is ready to start distributing, and just doesn't have a need for growth. There's maybe not a beneficiary that they're trying to provide for. They just want to draw this account down to 0 long over time, or there's really no need for any of it to start growing. So they desire minimal volatility. They want to see that their money sticks and it's there every time they need to pull it out, and they have significant immediate cash needs. They might just be taking their RMDs and they don't want to worry about it, or there might be a purchase of something, anything like that. They have no need for growth. There's no desire for the account value to increase. They just want to maintain, keep their capital, and see it hit their pocket. So this type of person would be, for the most part, in a lot of government securities, money market funds, some longer term debt, and just a little bit of equities at the end just to give some inflation protection rather than a lot of growth potential. So we might start in stage 1 with our, cash and cash equivalents, ultra short and short-term U.S. government securities, money market mutual funds, CDs, stuff that's not going to be moving a lot, but might give us a little bit of yield for our time there, because we don't want to get absolutely nothing on our dollars, but we also don't want to have a lot of volatility for this person. In stage 2, we might be moving to more intermediate term U.S. government securities, starting to introduce a little bit of volatility, but again, interest-bearing, things that are paying out good yield so that we can recapture some of that and not be super out there in terms of our volatility. Government mortgage funds and things like that. Again, these are more yield-producing instruments. In stage 3, we might have our longer term. So the great thing about having each of these with different length maturities is if you're buying individual bonds, say in stage 1 you buy a 3-year bond and it matures by the time you need the cash. You have a stage 2, you might have a 5-year bond or a 7-year bond, and by the time that you need to put more capital back into stage 1, it has matured. Same thing for stage 3, you might have a 10-year bond or a 30-year bond. And we just know that even with all the volatility in the market, if we hold it to maturity, we'll get our capital back. So that's another reason why we like bonds for an allocation like this. We'll use our investment grade corporate debt, still super high rated, good stuff, so we're not taking on a whole bunch of default risk. And we might use something like utility sector funds. Now, these are equities, however, they are historically paying really good yield. So we can get a little bit of that exposure to the equity market, but we're still focused on yield. We're focused on generating interest or dividends on our capital, so that instead of growing, we're just really getting paid for our time and we're fighting inflation. And balanced funds are a good pick to put here as well. Something where another manager is taking care of that volatility for the most part, and instead of getting a full equity position, we've still got something balanced back and forth. And again, those managers can work on that risk for you. And a lot of these balanced funds will tend to have the longer term bonds, so that's why we keep them over in stage 3. So a conservative growth investor, somebody who's a little bit less conservative than this person, they do want to see some growth on the other side of their portfolio, but they still have those immediate cash needs that need to be paid for. They desire strong yield. So while we were going for yield in the previous portfolio, we did forego a little bit of yield for lower volatility and less risk. This person desires a stronger yield. So in some of those spots where we have some more time, we might be taking on a little bit more risk to get even more yield. And they desire a little bit of growth. Not just a tiniest amount of growth to give us an equity curve that goes up, but maybe something that actually will grow for a future purpose, and they're not looking to deplete their portfolio entirely. This person, you'll see a lot of similarities, but you'll see some things adjusted. Stage 1 tends to stay relatively similar. Our money market mutual funds and our short-term government securities provide stability for us to withdraw to pay for immediate cash needs. In stage 2, we have short, intermediate, and long-term bond mutual funds. We're willing to take some of that longer-term risk to get a little bit more yield. We want our income-producing utility and preferred stock, managed mutual funds, index funds, all sorts of things like that. Again, focusing on yield and dividends to really generate some strong cash flow. Balanced managed mutual funds, index funds, and ETFs. Again, some of those really cheap, not quite as volatile as S&P and NASDAQ, but still giving us a little bit of exposure to that equity sector. And in stage 3, we can start getting a little more aggressive because, again, this client wants growth. Now we're looking at high yield corporate bond funds. We might be digging towards double B and single B. Long-term U.S. government securities, again, possibly we're looking for some appreciation with interest rates falling, but at the end of the day, we're locking in those higher rates that we are getting for compensation for leaving our money there longer. Index funds, conservative equity income funds, or dividend growth. Dividend growth and value are some of my favorites here, but you might also start putting some S&P and NASDAQ because we're willing to take on more volatility again for that longer. So you can start to see how when your objectives and your profile starts to change, so do your investments. So it is very important to know what kind of client you are. And this also speaks to the kind of relationship that you should have with your advisor or anybody who gives you recommendations on your investments. They should know what you want, and they should know what you're trying to do. They should understand how that information plays into what you would be picking for your portfolio. And if they are not aware of what you're trying to do or what your situation is, they'll end up making recommendations that might not be suitable for you. So let's move on to something a little more fun. The aggressive investor. They have absolutely no cash needs, possibly a young person in a retirement account where even if they were to touch the money, it's tax consequences, it's penalties, and we just want to let it ride for a long time. This person wants strong growth over a long period of time. We're looking for those nice big equity curves that go up over decades. They're willing to withstand significant volatility. It doesn't matter to them if they put $100,000 in and it drops to 75 in a few months, because that time frame doesn't even matter. We're looking for 10 years, 20 years, 30 years, 40 years even. We're looking for those long periods of time where we can take the volatility, because again, we call back to the law of large numbers. The more time that we have, the closer those averages get to what they're actually measured to be. So this person We could start doing adjustable rate government securities in stage 1, floating rate securities, short-term high yield managed funds, or we could even just forego the bonds entirely and do our index funds in there. If we don't need any cash at all, we could just put our S&P total market, big, broad value, all those sorts of things in our stage 1, because again, volatility doesn't really matter in the short term. We get to stage 2, we'll start adding some smaller capitalization companies, stuff like mid-cap, mutual funds, more index funds like that. Growth-oriented mutual funds, if you've got growth funds you really like, it's a great place to put them. High-yield corporate debt, really digging into that junk territory, because again, you can get some decent appreciation on lower-rated bonds if they stay in business. Stage 3, we really start getting into those small-cap mutual and index funds, individual stocks, maybe even some limited partnerships or other sorts of alternative investments that you can take a lot of risk on. And we're really just looking for a portfolio that takes a lot of risk to get a lot of return in the long term. So looking back over that, stage 1 generally provides for those cash needs and the stability of the assets. And stage 2 is generally designed for intermediate liquidity, modest risk, and intermediate term horizon. And in stage 3 is generally designed for long-term results while experiencing short-term volatility. But again, all the stuff that we just looked at says that all of this can be subject to change. If you are not the investor that this applies to, then you use something else. Those conservative investors, they might just want all short-term government bonds. And that's okay. If that fits with your plan, if that brings you to success, there's nothing wrong with that. Every way of investing is different, and every portfolio that you build should be different because it should supply a different need. The only thing that matters is that you have a high chance of accomplishing the goals with that portfolio. So we'll start looking at vertical integration. Start looking up and down on this, and we can start doing. And we like to start with this pyramid shape because it kind of gives the visual idea of how these sections are built. Generally, we start with our total market, low-cost index funds, things that are super cheap as the base, because really, we're just trying to participate in overall trends. I'm not trying to call markets. I'm not trying to pick the perfect sector that's going to give me a 10,000% return over the lifetime. That doesn't really matter. We want to get in the game, we want to stay in the game, and we want to play it for the long term. We start moving up, and as we go up, our allocations get a little bit smaller. So they'll be the largest down here. Our cheapest funds are our largest allocations. And as we move up, we get a bit smaller. We start looking at sector funds, factor funds. And you think of a factor fund as just, there are certain factors that we use to choose an investment, like value and junk bonds or any of that sort of thing. Asset allocation funds are also great here. There's a couple good funds that'll give you a balanced portfolio pretty much within a mutual fund, and you can use that as one of your positions there. And we get all the way to the top, we start looking at our managed funds. Now you can obviously include your single stocks and speculatives up in here, but we like to put managed funds that have good tenure, good results over long periods of time. But really, when we're looking at this, you can kind of imagine, instead of each kind of investment, think of it as the further up you go, the higher fee you pay. We want to pay the lowest fees at the bottom because that's the majority of our portfolio. We're not interested in handing over a ton of fees to managers that aren't doing anything special. And then as we move up, we get a little more specific, so we're willing to pay a little more. And as we get all the way up to the top, maybe there's one manager we are just completely enamored with. We want to give them 2% a year, but we only want to give them 2% on a small allocation of money, not our big majority positions, because then you're just kind of giving away money at that point, unless they're just the best manager ever.
So what's the range of fees when you bring up cost, and then is it less activity for the lower cost, higher activity for the high cost?
Generally, yes, it's less activity in the low cost, high activity in the high cost, but fees can really range a lot. But generally, when I'm building a portfolio, what I'm looking at is, down in this section, I want to be paying less than 20 basis points, which is, a basis point is a percent of a percent. So if I say 20 basis points, that's 0.2%. I want to be paying less than 20 down here. I like to pay 15 or 10 or 5 or 2. I like having those costs down here. And then up here is where I'm kind of willing to push beyond 20 basis points, maybe closer to 30. And then as we get to the managed funds, that's where I'm willing to pay close to 1%, or maybe even more if there's something absolutely ridiculous that I just have to be in. And you'll see the highest cost funds are usually the funds where nobody's really making funds about them yet. So Bitcoin for a while. I don't know what the fees are on the new Bitcoin funds, but I remember the Bitcoin futures funds, before they were allowed to actually hold the coins, they had to trade the futures contracts, and those were like 2%, 2.5%. They got really high on those fees. So again, it kind of really depends on what we're looking at, but for our general range, I like to stay below 0.25%, between 1/4 and 3/4, and then 3/4 and up above that. I would say that's my most general
Do you have any
for
funds
fees.
in the top managed one that are worth paying a high fee for?
Possibly, and we'll talk about those in a little bit. So we're looking at level 1 now. The base of our portfolio has the purpose of participating in overall market trends. Again, I'm not trying to do anything special. The hedge fund manager that everybody wants to be. I just want to participate in the overall expansion of the economy over time. I'm not playing a game with the investments. All I'm doing is getting in, and as the economy continues to expand, I hope that my dollars tend to expand with it as well. We're seeking same as the market portfolio performance from these assets, whether they're stocks or bonds. So whether it's a stock index or a bond index, you want to see the same as that category. So if I'm doing a total market index, I don't want to see a whole lot more volatility or a whole lot less. I want to basically be riding the exact same wave as the total stock market is riding. And that's why we like those low costs, because they mimic the stock market really well and you pay very little of a fee for that. And that's why I want to be in there, because I don't want to be handing over money for no reason when I could keep it simple and feel most of the movement of the stock market with this total market fund. So we're looking for funds that have very little unsystematic risk. We don't want to see stuff that we could diversify away, because that puts us at a position where we have other risks on top of market risk that we're now subject to. If we're building a level 1 section of our portfolio, I don't want to be so concentrated in a particular company that I'm worried about that company going out of business. I don't want to be worried about a particular sector having a big downturn. I want to be diversified across everything, because I know that as an overall statement, generally, stocks go up over time. The market goes up over time. And I don't want to be in a situation where I'm concentrated in the one sector that doesn't go up over my time frame. I want to be spread out across everything so I can take that high probability performance of slow growth over time. So we're looking at broad-based, low-cost index funds, really just hammering in that and over again, those total market index funds for bond indices, stock indices, international, global, whatever it is. Broad, lots of securities inside that, lots of stocks, lots of bonds, and low cost. I don't want to pay 2% for these funds. There's no reason to. There's a lot of really cheap options out there, a lot of really great ones. And in fact, we'll look at a couple examples of things that could fit that. Fidelity has a total stock market fund by the ticker FSKAX. And this is one that I use a lot when I'm starting to build a portfolio, because it's a really good, super cheap total market stock mutual fund. It's like 1.5 basis points. It's amazing, super cheap, yeah.
I'm just, so I see the total market stock names. Does that say that every traded stock is on there, or some of the ones are not?
It's pretty close to every traded stock, and usually it's looking at just kind of the U.S. exchanges, like New York Stock Exchange and stuff like that. So yeah, pretty much every stock. So we're looking all the way from the top all the way down to the bottom. Everything that's publicly traded. We're not looking at over-the-counter markets or anything.
Share cost, or how does it?
So I'm not sure about these particular ones, but yeah, a lot of the times they can be equal.
You'll find a total stock market index fund wanting to have the same big computer positions that the S&P 500 have, but then it has a lot smaller positions. And yes, they are slightly different from Vanguard and Fidelity, but they're trying to
dollars of Apple and X dollars of small.
A percentage of the fund, yes, relative to the percentage of the overall market, right, Ken?
Yes. So it's based on the capitalization of the.
Yes.
of
So
Yeah,
you're not-
for the most part, yeah.
Yeah, you're not gonna avoid the volatility just because you go to a total stock market index. You're just gonna have a many more lower level, smaller positions.
A lot more small ones
Yes.
to make up for the.
Yeah, and therefore he may pick a total market value index or something just to avoid that.
Yeah. So in terms of that Fidelity fund, it has over 3,850 individual stocks inside of it. So that really is helping us with our unsystematic risk. We're really minimizing that risk of a certain company completely evaporating. We're really minimizing the risk of bad management, minimizing the risk of all of these different individual things that any company could subject us to. We just want to be in the market. When I think of the market, I'm thinking of these total market index funds. And we've got a very similar offering from Vanguard, but it's an ETF. So remember, mutual funds typically for your qualified accounts, ETFs for your non-qualified. But when you get to a lot of these index funds, they usually don't pay a whole lot of yield or distribute a lot of capital gains because they're not buying and selling a lot of the time. So they'll be very efficient in comparison to some other growth funds.
And one thing you'll see is Vanguard is twice the cost as Fidelity. Normally, exchange traded funds are cheaper, but because Fidelity's trying to beat Vanguard, they can subsidize this and drop the fee just so they look better. But be careful because if you go into Fidelity, there's other funds that have higher fees. So overall, it's safer to go to Vanguard with your eyes closed because everything will be right. But watch out for Fidelity and Schwab because you'll bump into some high-cost funds. This is a loss leader for them.
Yeah, I was about to mention that. A lot of funds you'll see that are super cheap, they're great, but they're also loss leaders. They want to pull you into their family of funds so that you can buy more of their high-cost funds. Now, we don't really care about the rest of those funds. I just want to get that cheap one, get my nice big allocation, and ride the wave. So Vanguard's total market index or total market ETF, ticker VTI, has over 3,740 individual stocks. So you can imagine these two funds are pretty similar. They're almost exactly the same with a difference of 110, 120 different stocks. However, this one is twice as expensive, but twice as expensive and still 3 basis points, which is still almost no fee at all. So I'm willing to take that. As we move on, we start looking at a short-term U.S. Treasury ETF from Schwab that has a fee the same as the Vanguard total market of 0.03% and almost 100 individual U.S. Treasury notes. Now, something to keep in mind is diversification in U.S. Treasuries in terms of the different notes doesn't really help us a whole lot, especially when we're in short term, because what are we diversifying away from? So it's very common not to see thousands and thousands of the same short-term U.S. Treasury notes because they're all going to be basically the same. So you'll see a lot lower count on some of these.
Question?
Yeah, so I'm still working on putting money into my tax deferred account
Yeah.
at work. And so does it really matter if I have the ETF or the mutual fund? I mean, I realize the internal cost, but I'm
Right.
looking for tax reasons.
Right, and you have a qualified
I'll still
account,
be
right?
taxed, right? The same.
Yeah, and
Yeah.
and you won't have ETFs available either.
Oh, yeah, because I did check,
Oh,
right? We
right,
talked about
yeah.
that last week. Yeah, they're all the mutual funds.
Yeah.
Mutual, okay, yeah.
Why would they not have the ETF?
Anybody have an idea? Oh, well, one thing is the
They
mutual
write
funds.
their own mutual
Yeah, the
funds.
mutual funds negotiate with the plan provider, the 401k, and they pay them a fee to use their mutual funds. ETFs don't mess with that. They don't pay anybody a fee. They don't pay part of their management fee because some 401ks you could go into and they don't charge the company a fee because the company will use the funds that they'll give a part of the management fee under the table. It's legal.
Well, this is a school district.
Yeah, and it's old school too. Some new 401ks are starting to allow for ETFs that you can either do on your own or it's on their list, but it's more work for them, it's more liability, and they may not get extra fees.
You know, my 401k lets me do anything I want.
Yeah, with your own brokerage account?
Yeah.
Okay.
Yeah, so does ours.
Yeah,
So it's
okay.
at Fidelity, so I can
Yeah.
put anything I want. I have to put 5% somewhere else, but 95% can go into
Yeah.
self-directed.
And do they educate you on that?
mean, they offer education, but okay.
They need to offer, because people that do their own trading, maybe you're a tradeaholic and you lose all your money, then you come back and sue your employer for giving you the freedom to do your own stuff.
Yeah, they offer education.
Yeah, okay.
Any of those indexes or mutual funds, are those things callable?
Callable. I don't think they would be callable. No,
So I've
no, no,
never
no.
heard of it. Even with the bonds in them, the manager would have to worry about that. But I've never heard of callable bonds or stocks in an index fund.
Yeah, I don't think that would happen in an index fund. And even if it did, it'd probably be one of the many hundreds of bonds, possibly is one of them. But again, like for indices, they're trying to go like the whole index. You're looking at this.
Yeah.
So I don't think
Seems like
so.
it could be, but I don't know. But we're not talking about stocks. I've never heard of a callable stock, right?
Yeah.
Have you? I haven't heard. Okay.
The other one that we have on here is VBTLX, which is a total bond market index mutual fund from Vanguard that has a fee of 5 basis points, so 0.05%, and over 17,750 individual bonds. So we're not too concerned about an individual bond failing. We're not too concerned about credit quality too much because we've got everything from AAA all the way down to single B and possibly even below. So these were very popular for a while when bonds were seen as a very safe investment before interest rates started moving around a lot, and when yields were pretty high as well, because you just get diversified in everything. You have your longer term, your short term, your intermediate term. But the problem with that, at least from our view and my view, is you can't get yourself out of the higher risk bonds. You can't get yourself out of the longer term bonds and mitigate that interest rate risk. You're just subject to whatever the index happens to be. So when I'm looking at bonds, I prefer to split it up into individual funds, my short, intermediate, and long, because it allows me to position properly when I see a lot of volatility coming, or if I just don't want the volatility, period, I can just get rid of it.
This allows you to diversify the risk of bankruptcy, but not diversify the risk of interest rates rising or falling.
Yeah.
Now we're looking a little bit more at a total bond market index being a little more friendly because interest rates are up. But they did get hammered a couple of years ago, 20%.
They do
Yeah.
have callable bonds.
They do have callable
Yeah.
bonds.
Yeah, they will.
I'm sure they do.
Yeah.
And if you're worried about that or the risk of any bonds, then we say go with a bond manager, because the reason there's 17,000 bonds, the stocks have a limited number of stocks available to buy, right? There used to be 5,000, now there's maybe 3,850, but the bonds keep getting, issued and things like that.
Yeah.
So the total return for the Vanguard one at the bottom for last year, 3.78%.
Yeah.
5 years, 1.27.
Yeah.
So not that good.
Yeah.
Well, not good in the past, but if you bought it, let's say 6 months ago, when it was at one price and people thought interest rates are gonna fall, it might have a total return of 7% for 6 months, but, or let's say a year, it could be 7%, but the yield on the fund could be 4.5 or so.
Right, and that's one thing to always remember is when we're looking at bonds, we're looking to generate yield. We're not looking for returns that are super high, especially over these longer periods of time, because often they'll keep equalizing to very similar returns over time. Their returns are pretty low.
Yeah.
So is the yield the cash payout then? I
Yeah.
can't remember.
Yeah.
Distributed.
Yeah,
yield.
dividends and
Okay.
capital gains distributed. Basically, everything that comes out to you.
Total return
Right.
on.
Total return is the share price plus the
Yeah.
dividend. So if the share price dropped 5%, you earn 5, you earn nothing. If you sold it with a 5% drop in price, you gave up your dividend, right?
This
But
is
if-
the total return.
Yeah, but if you keep investing, the dividend distribution of 5% is buying more shares as a drop. So going forward, this may be a great fund, but if you had it 2 years ago, it was horrible. So you've got to look at total return is nice. It bails you out if the market falls because the dividend helps make up for that. But if you're going for yield, this is something that'll lock it in if you think rates might fall and not ever go back up. But it is risky. Right?
Yeah. Oh, sure.
I know we've talked about this before, but I just want to get it straight. ETFs, don't do capital gains, or you may not see capital gains come through? So
They
it might be- that's why
can,
they're better-
yeah, they can do capital gains distributions, but across the board, they almost never do, from everything that I've seen, from everything that we've seen in the business. I mean, we've said for a long time that they don't, because we've just never seen it until I dug and did some research and found that it was actually possible. But again, with their relationships with market makers and some more advanced politics and stuff that I don't understand, they're able to not distribute those capital gains out to you as an investor.
Is
So-
that why they're better for non-qualified employment?
Exactly.
Or even a brokerage?
Right.
Exactly. Yeah, if you let me manage a real estate portfolio and I was gonna buy and sell, I would do what kind of exchange? 1031, right? So that's kind of what the ETF has a right to do, is the authorized participant can do almost like a 1030, I'll give you this and you give me that. And then they'll trade for a stock that has very little gain and give the market participant the one that has a lot of gain. So they can manipulate that. They're allowed to do it in the ETF with the mutual funds. They can, but don't do it very often. And new ETFs, you gotta watch it, because now the old index ETF is out there, but the new managed ETF where they buy, they sell, that's gonna kick out capital gains.
Where do you see that? I like most, when you or whatever, you put in a stock or ETF or whatever, somewhere in the chart there, it'll talk about, not just the yield, but it'll say what's taxable, what taxable dividends or whatever.
Yeah.
Right.
You know what he's talking about? I always get confused. It says, potential capital gains or potential gain or loss.
Well, so in terms of potential capital gains, that's basically looking at what are the open positions right now.
Okay.
So what is in there that, if they sold, could produce a capital gain. So that's kind of what that is.
Especially in a mutual fund, because if you buy it and all of a sudden they sell those positions, you pay the tax even though you didn't get the gain.
Well, there are ETFs that actually start to give you your return your money and keep the gain inside so you keep the taxes.
Okay, that's a managed, I mean, they're doing it for that reason,
Yes.
right? But for the most part, if you have more index type ETFs that buy and hold, and they can trade stuff if necessary, because back in 2008, Vanguard's S&P 500 fund, people got panicked and wanted to get out. They had to actually sell stocks, which triggered gain, which normally you buy an index not to have any internal activity, new money in, old money out, and you sell it at a gain at your time. But back then they ran into that. But an ETF would not have that happen, because the ETF doesn't have to liquidate your money. You have to go find a buyer for your shares. Therefore, the owners in an ETF are immune from one person selling. So we like to call them exchange traded mutual funds for the most part.
Yeah.
For that efficiency.
So moving on to sort of the midsection of our portfolio, again, our allocations are starting to come down in size and go up in volatility and risk in certain factors. So the midsection of our portfolio has the purpose of generating exposure to more targeted investments in both equity and bond categories. Basically, we're just getting more specific. We're looking for opportunities. We're not just playing the big game. We're looking for something to get into, whether that is just a sector that hasn't been doing super well, or we're getting into something that's a little more volatile that should theoretically give us a higher return over time. So again, like I just mentioned, seeking opportunities in depressed sectors and more volatile indices for stocks. And we're looking for higher yields for bonds, whether it's corporate debt, longer-term government securities, stuff along those lines. We'd be looking at index funds that mirror specialized indices and allocations. So we might be looking at small cap index funds, mid cap index funds, international index funds, value index funds, growth index funds, more targeted things, more specific towards what we're trying to achieve. We might be looking for more specific market sectors, like I just mentioned, utilities, tech, and energy, consumer staples, consumer discretionary, a lot of these words that just really represent certain pieces of the economy. So if we notice that a certain piece of the economy is doing really poorly at any given time, it's pretty likely, especially if it's a cyclical asset, meaning that it comes up and it goes down pretty regularly throughout the economic cycle, We can enter it when we see that it's been having a rough time, and possibly as we start to change business cycles or just the economy moves on, it could come back for us later. So a couple examples of what we might put in the midsection of our portfolio. We've got two really popular choices that people use in their portfolios all the time. One is SPY, which is a S&P 500 tracking fund from SPDR, and this is an ETF. All of these are ETFs. And it has a fee of 0.095%. So we see that our fees are starting to come up a little bit. We're starting to be willing to pay a little bit more. But the reason we're doing that is because we're getting a little more specific of an investment, something that is giving us more specific exposure. And we're willing to pay that our return should be higher from this investment. Therefore, we're going to make it back anyway. QQQ is another one of those, and that's for NASDAQ. So you'll hear those tickers a lot from people that invest because they're just super popular. Most people know what they are. And the QQQ is from Invesco, and it has a fee of 0.2%. Again, that's getting a little higher on our fees. This is why we have these investments in smaller portion sizes, because we don't want that fee to eat away from our returns. Moving on, we also have FUTY, which is a Fidelity Index fund that tracks utilities. So you'll have a lot of those companies in your utilities sector, and again, pays pretty good yield most of the time. And this has a fee of 0.084%. Still low, still nice and cheap that we like, and gives us exposure to a specific sector. So we might be in utilities one day, and then we might rotate to another consumer discretionaries maybe, and then we might rotate back to utilities. These are the things where we're moving in and out. We're a little bit more active in our trading, even if it's not active trading every day, but we can be rotating from sector to sector.
I had asked you before, QQQ is a very popular technology fund, right? A lot of people know about it. The management fee's not all that low, but it's decent. And then I asked you, what about QQQ, was it E or something like that?
I don't remember.
They had another one that was a total index where everything was equally weighted.
Oh, equally weighted, okay.
Yeah, and so you didn't really like it because it didn't give you the positions that you're seeking in technology, right? So why not? Why do, it's a gimmick. It's not a bad thing, but instead of having QQQ with the biggest technology stocks at the top, they came up with another one where they're equally balanced and not so much in NVIDIA and some of these big companies. But Nash came back and said, what's the point? I mean, you're going to QQQ to get those bigger weightings, right?
Right. When you look at these indices, especially ones like this where you have those really big companies at the top, something to realize, most of the returns you're getting are from like the top 5 companies in these indices. You might have 500 companies. We don't care about most of them. They're not giving you those really good returns that you see over time. When you see that S&P is up a lot, most of that comes from Apple, Amazon, Microsoft, any of those big, huge companies that you know are at the top of those allocations, because those are the ones driving those returns. The bottom 10, 50, 100 stocks might be horribly performing, but they just give us some diversification. So if I'm going to go to a fund like QQQ, when I looked at this fund that he's talking about, what I noticed is we got significantly less upside and relatively similar downside. At least from the limited information that I was looking at when I researched it, is it just didn't really felt like we were giving up a lot of returns and not reducing our risk profile by that much. So if I'm going to go into this fund, I'm going to go into the index that I know historically works and the data supports.
You have to look out for gimmicks, because they were trying to use the QQQ symbol to get more money into this other fund. And that's not a ripoff or anything, it's just a gimmick. So what's the point?
Yeah. So another one that we've got is IWS, which is a mid-cap value stock ETF from iShares with a fee of about 23 basis points. Now you can see we're starting to get a little bit more specific, because we could have just had a mid-cap index fund, all of our mid-cap stocks, but this one is specifically mid-cap value. So we're specifically going for slightly smaller sized companies that have good value, that are earning money on their shares, that might be paying dividends, and we're getting that nice targeted exposure. So if we think that it'll be more worthwhile to invest in mid-cap companies that are already profitable, that we think are going to continue to grow in the future, this might be something that we use. across the board, I'm just a fan of value stocks for the most part, because it lets me get a client into equities, into stocks, while still having a little bit more stable returns, a little bit less deviation up and down, but we're still getting that exposure, and we're generally generating some yield because those dividends get paid out and we can reinvest those. So it's always nice to get into something that pays you for your time, even if the capital gain return is not amazing. It's nice to take those dividends and buy some free shares. I'm always a fan of free shares. So moving on to the very top of our portfolio. Now we're getting to those super specific strategies or anything else that we value a lot. The very top of our portfolio, and remember, the smallest allocations, these are not big positions, has the purpose of taking higher risk than we would take overall in seek of opportunities or to benefit from tenured management experience in a particular sector. So we might not necessarily be taking extra risk in this. We could be paying a lot of fees for somebody that we know has had a really good track record in a particular sector and might be able to give us extra returns. I like to think of this as something we sprinkle on top for the possibility of eking out extra returns, but if it all kind of goes horribly, it's such a small percentage of our portfolio that it doesn't really matter because the overall trend is still continuing. It's those low risk, high reward scenarios that we're looking for in things here. We're willing to pay higher fees for very particular strategies or management teams. So you might have, there's a fund, T. Rowe Price Capital Appreciation has been a fund that outperforms its category, its index, its competitors time and time again. Now you can't get in it anymore because it's closed, but that is one of those funds where you might be willing to pay a higher fee because the extra return that they generate is so great that it is better than if you had just had the same position in an index fund. These allocations remain small so that if they were to fail, the overall impact on the portfolio would be minimal. But if they succeed, we're able to add some additional and or non-correlated returns to the portfolio. Non-correlated is a fun way of saying diversification. It really is just saying a return that goes in a different direction. Even if overall it still goes up, there might be some moments where the overall stock market is maybe performing poorly or trading sideways, but a particular sector or a particular management team thrives in that scenario, and so then we get some extra returns on top of our overall long-term returns of our portfolio. So these will come down to our well-managed funds, things where we just know that we have good managers, people who've been doing this for a long time, and they have specific strategies that we are looking for. You might have defensive management techniques. There are some really interesting funds that did poorly a little while ago, and they were covered call selling funds. So basically what they would do is they would buy the index or buy an index fund or something like that, and they would sell an option to sell that fund on top of it to generate a little bit of income from the premiums. And then if that fund never rose in value enough to trigger that sale, they would just keep the money, pocket it, and reinvest it back into the fund. But when a market would take off, all of their assets get sold away from them, and now they don't have any more exposure to that growth. So those are mostly useful in a bear trending market, and it's difficult to position those at the right time.
That call option would be similar to you give your neighbor an option to buy your house at the full value plus 5%. And so if I can buy my neighbor's house for 105%, unless it goes up more than 5%, I wouldn't do it, right? So if you need an extra income, you sell somebody the option to buy your house at a set price, and if it goes beyond that, they're going to make money and you're going to be sad. But if it never goes up, they keep paying you this premium every year and you make some extra cash.
Yeah, the best case usually for selling options like that is if you have something that if you got to a certain level, you'd be ready to get out of it anyway. Something that you're already looking to rotate out of, but you don't want to just get out of it at its current price. You might be willing to get out of it $5 a head or something like that, and you just keep getting that income until it pushes in price away to get called away from you. And then you've got a little bit of extra return for your time. So these level 3 funds can also represent very volatile or sensitive sectors like Bitcoin we were talking about. If you want to get speculative, this is the place to do it. We might be looking at very, very volatile growth stocks or growth funds. Best performing managed funds might charge higher fee than most index funds because obviously they're doing more work than the index fund, but it might end up being worth it if their track record suggests so. So we'd be looking at managed stock and bond funds, preferred stock funds, emerging markets, new areas, new sectors like even the cannabis market and things like that where it's emerging, but it's not quite solidified enough to have a predictable outcome. So a couple examples of what we might be looking at here is one fund that I've been looking at a bit recently and I've been using, PRWAX, is kind of similar to T. Rowe Price's Capital Appreciation, but I think this is kind of just the new generation of a fund like that. So this is their all-cap opportunities fund. Basically what that means is they're investing in companies of all sizes and not really discriminating based on how big the company is, but rather if they see an opportunity with it. If Apple has an opportunity, they're going to buy Apple. If a teeny tiny little company has opportunity, they're going to buy that. Now, this fund has actually outperformed one of the most difficult Morningstar categories to outperform, which is the Russell 1000 Growth Index. That's just a growth index of a lot of different funds, a big diversified section. And historically, this is a really, really, really hard category to beat. But somehow, this fund tends to beat it year over year. And with lower volatility. It has a lower deviation up and down of your dollars, but a higher overall return. So you're making more money for taking less risk. Now, obviously, you can't promise that this is going to happen forever, and there might be an economic cycle that is just completely against all of their trading strategies, and you have a horrible year. But they tend to, over time, show us that they have a pretty decent ability to give us more returns and lower our risk in those positions. Moving on from that, we get to PIMCO's Income Fund, ticker PIMIX, which has outperformed most multi-sector bond Morningstar category peers. So most funds that are doing your very diversified, lots of different kinds of bonds, they're outperforming those peers a lot of the time, and it's well regarded by the analysts. This has a lot of really high ratings from Morningstar. It's gold, 5-star, I'm pretty sure it's 5-star, 4 or 5. It just has really good ratings across the board from Morningstar. Now, Morningstar isn't going to be, they're not a saint. They can't get everything right all the time, and you can't just buy a whole bunch of 5-star funds and expect to outperform everybody else. But they do take a really good deep look at what's happening, and they look at the management team, they look at the strategy, and they evaluate it and give you their thoughts. So it's a useful sort of educated idea of how they're doing. So if you don't want to go do all the individual research, Morningstar provides a lot of information that can be super useful.
The stars on the Morningstar rating, 1 to 5, that just says where it ranked historically in its category. So the top 90 to 100% of ranking would be 5 stars, all the way down to 1 star. And you want to stay away from any 1 or 2 star. Now it is possible you could have one that gets a 1 star because it's like a Bitcoin. Who will we compare this to? But they get a gold rating because of how well they're structured. So the stars don't tell everything, but for the most part, only do 3, 4, 5 stars for historical comparison. And then the gold medal rating tells you those things you just mentioned.
Yeah. And one thing that you'll notice, I forgot to mention, the fee of the T. Rowe Price is 81 basis points. We're starting to get close to that 1% mark. That fee is for a particular thing. It's for that extra performance that they've got. And PIMCO's fund as well is getting a little higher at 62 basis points, so 0.62%. And those fees, again, it's for that historical performance. It's for that long tenure. It's for those regarded management teams. It's for that experience that you're paying for. And in some of these funds, it tends to pay off. Now, again, it's important to remember that these are our smallest positions. I'm not looking to put my entire portfolio into PRWAX unless you're a super young investor and you've got all the time in the world, in which case you might not worry about it. So moving on, we'll look at something that is an interesting investment, and it's new, and it's something that's coming up a little bit more these days, which is iDrive, IDRV. This is iShares self-driving electric vehicle and tech ETF. What it's trying to do is position itself with companies that invest in the future of automotives, that invest in self-driving cars, electric vehicles. So if that's your thing, if you're excited about Tesla, Ford, and all these different companies creating these electric vehicles, you might look at this. However, it's important to know that even if new sectors are exciting, they don't necessarily perform well. This has had some pretty big downturns over the last little while, possibly from large allocations in companies like Tesla, because it's a very volatile stock. If you've ever watched Tesla, it has had really high values, really low values. It goes all over the place. But this charges a fee of over that 0.5% mark, but getting pretty close. You want to talk about your experience with this fund at all? What have you noticed about it?
Oh, I bought it a few years ago, and then it had done really well. But when we say it's done well, it got very popular, right? Because long term, a stock can do well based on performance of the company. Short term, if it does well, it just became popular. So we got to kind of get rid of that thought that they're doing something behind the scenes, and boom, they're way up. So it went way up, and then when interest rates went up, because when interest rates came from nowhere and all the way started to 5, they became a really good short duration, big investment for a big return. Your long duration investments were stocks, especially technology. They're there for you to make money in the long term, not the short term. So when people left and dumped stocks and technology to buy short-term CDs, technology dropped 35%. S&P dropped 30%. But now it's bounced back magnificently within 1 year, but it was already down 50 or 60, so it's up 80%, so I'm barely breaking even. But if you like this area in this sector, this is one of the funds that could give you that exposure. But it may be a little late for the big GameStop type, increase that everybody loves in the short term.
So stocks are doing pretty well right now, but also interest rates are high. So why is that? I mean, because typically there's the inverse correlation, correct?
Right. You would normally when the market was down and interest rates were high, that made sense. But then everybody thought that the Fed was going to drop interest rates 4 or 5 times this year, so the market went way up. But then when the Fed said, I'm not going to drop it, but we got new economic measures saying unemployment's not as bad or people are spending more money and going into debt, then the stock market stayed high, and there's still trillions of dollars on the sidelines waiting to get back in. So in the mid to long term, we'll probably see a pretty good market, but as soon as anybody speculates, run the other way. That's why you got to do the way Nash is talking about, because that fits what your needs are. Now, what's the most big popular sector, specialty type of stock or fund today? Tech. And which tech? Which stock has gone up so much? The chips, right? NVIDIA has gone up a lot. But a year or two ago, I don't think it was up this much.
No, not this much.
Good, bad, good, bad. But all of a sudden, everybody's talking about AI. NVIDIA, who makes chips, is through the roof. And they still say it's a good price, but you got to stay away from what becomes super popular. Either make that choice ahead of time, or let it fall back and get a second chance buy.
Would you be paying close attention to a beta at that situation?
Would you?
Are we talking about individual stock like NVIDIA?
Yeah.
Kind of hard to say. If we're looking at an individual stock like that, at least in the way that I pick individual stocks, reminder, don't do this. I don't do this for clients, ever. I do this for myself. But if I'm looking at an individual stock, I just want to see what value it gives to the marketplace. I don't care what the analysts say of it. I don't care what technical indicators say of it. I don't care what I just want to know that they're providing something that's valuable. So I'll talk about my best stock play I've ever had, which was AMD. And the reason that I actually was successful in that trade, one is because I was early. I bought that stock at $10 a share, and it has gone up significantly since then. But the reason that I was interested in the first place is because I have built computers in my time. I understand how that works. I understand what is offered. I understand what the marketplace looks like. And at that time, there was a complete monopoly on a particular piece of computer equipment. on a certain thing that you bought. The brain of the computer was almost exclusively made by one company, Intel. And when AMD started to announce that they were going to release a competitor to that product, I was shocked that the stock price did not go super high and start flying into the sky. But I knew that I saw a future with that because of all the information that I was hearing about what they were developing, when the products were coming out, when people would review them and look at them. It seemed like a no-brainer to me. So I loaded up on AMD, and lo and behold, they started gaining market share. And that is what I saw. I didn't care about beta. I didn't care about PE ratio. None of that matters because I knew that they were going to bring a value to the marketplace.
So you look at the sector of what's actually happening.
Right. Like, I care so much more about what are they offering. I like anything about their stock price. That's all whatever. It doesn't really matter to me. I just want to know that they're going to offer something to the marketplace that's going to increase their value. And a lot of times you'll see that with the other thing that I saw was they were actually at net losses much heavier than they had been in the previous decade. But to me, that was a good sign because that meant they were spending money on their product and making it a good product. So I found that interesting, and that's why I entered that. I've never replicated that performance ever since, keep in mind, but that was a good reason to go into that.
But high beta is a good thing when you're looking for growth, right? If you're a nest egg investor wants low beta, low risk, and you don't want to lose it, but if you're out there to make the maximum gain, the high beta is not a good thing.
Now, keep in mind, beta only measures what has happened.
Right.
It has no, it doesn't, unless you're looking at a big diversified fund, it's really difficult to use that as a projection of anything that could happen in the future. The reason that NVIDIA's beta is high right now is because it's been on a tear. If it hadn't been on a tear and it had been level for a while, it'd have a low beta. It just is a representation of the data that we have in the last whatever period you're measuring against.
So stay away from trends. Short-term popular, everybody's running to AI. It'll probably do what they say, but it'll probably tank for a while and then ultimately come back, just like 2000 with the tech bubble.
Yeah, so I wouldn't buy it just because it's up a lot. I'd buy it if I think they're going to offer something that is going to be useful. But clearly, they've already offered it. So you're kind of catching on to that late. They already have been developing AI chips and all this sort of stuff for decades now. That's already been part of the marketplace. So you're kind of getting in late to a trend, like he's mentioning. So for me, those opportunities, I need to know that they're going to offer something. It's coming, not just it's hit and now it's going to go crazy forever. I think AI is going to take over. I would just rather wait until I see something that's going to offer a lot of value. Anyway, when we're looking at these investments, especially our stage 3, something to kind of keep in mind is to think of your portfolio like a boat through the water. You're going through the ocean, and sometimes big storms are going to hit you really hard. And briefly, we can dip under the water, but if our boat is nice and buoyant, if we don't have any leaks, if we're not just absolutely losing to the environment, we'll come back up and we'll get to calm waters. So it's all right to see that volatility, and we have to be comfortable with it, especially if we're looking for growth in our returns, because it's part of the game. It's staying alive is the most important thing. Keeping your money intact for its purpose is the most important thing. Even if you talk to day traders, they'll have the same concept. Staying alive is much more important than making all the money, because if you lose all your money, now you have nothing. So it's really important to be willing to sit through this volatility, but be allocated in such a way that it is not detrimental to your future goals. You don't want to have it be such a big risk that now it's bringing your probability of success down, but you need to be willing to sit through it if it fits your plan. So as long as you've created the right plan, you know what your asset allocation is supposed to be, it's okay to see red days, it's okay to see red months, it's okay to see red years, because you know what the data is going to do over long periods of time, and you have to be patient and willing to wait through that.
Historically, the market's always recovered, right? There's no chart out there showing it not recovering at some point. The market will always recover, and it will always keep going up, but not consistently. Why would it keep going up? Any ideas? Demand. Unfortunately, when you have too many people being born and countries going from low poverty to middle class, they demand what? Goods and products and services. And so the creators of the goods and services learn how to become more efficient. And unfortunately, too many people buying the products cause the demand on it. Now, how can the stock market do well and then we experience things like prices going up and shrinkflation? That's that's the company surviving with their higher cost to produce things. They raise the price a little bit, shrunk the product, they keep their profit margins going, and then we look around and say, I want some of that. We don't want to hurt people with prices, but that's how they survive, is they raise the price and or shrink the product to keep their profit margin in so buyers will buy the stock. So it's not guaranteed. I can't guarantee the market will keep going, but long term with the demand on it, I don't see any other way.
Yeah, so to your point actually about stock charts never showing that the stock market doesn't recover, here's a nice big chart of stocks, bonds, bills, treasury bills, and inflation from January 1926 to December 2022. And you'll see a lot of big market corrections. Now on the big chart, these don't look very big, but if you were investing right here at this period of time, that feels like the end of the world. That feels like the financial markets collapsing.
What year was that?
This was right about 1970 something, 1970, 1960, something like that.
That was that big recession and oil embargo and all of that.
Standing in line for gas.
Right, so if you mess with energy, I wish we could all be on batteries, but when you mess with energy, it slows and ruins the economy quickly.
So where's 2000?
2000 be right around here.
Yeah, there was a
There's the 2008.
Yeah, you can see 2008 right here, which looks like almost nothing on this chart. It's barely a blip. You could, if you just blinked, you'd miss it. But if that's when you're invested and that's when your time frame is, it feels like everything. So
yeah, and explain the top blue line, what that is versus the next one.
oh, the top one is small stocks. The next one down is large stocks. And then we have bonds, treasury bills, and the gray is inflation.
And if you go back to 1925 with $1,
Yeah.
what does bonds make you over 80 years or something versus?
Bonds bring you to $131. Large cap stocks bring you to $11,505.
$1.
And small stocks bring you to $49,000.
So if you'll just give us money to build that time machine, we'll go back and just give us $1 and you'll get 49,000.
Yeah.
What did I know?
Yeah, right. 5,000.
Yeah. So our takeaway, creating your customized portfolio requires allocating properly for your needs, as well as diversifying between different funds, fund companies, stocks, different types of sectors, all sorts of things. And to address these needs, needs and time frames, we use lateral and vertical integration concepts. So we use all the stuff we just talked about to satisfy those needs, to satisfy everything that we want from our portfolio. Each portfolio will be unique to the person and the person's needs and risk tolerances. One thing that I like to emphasize is it's not always just about the numbers. It's not always just about the returns. If you can't handle volatility, that's fine. You can decide not to go through intense volatility. If you can still fund your goals, you can dial it back. You don't need to succeed 150%. You just need to succeed enough to fund your goals. So if you don't need $10 million, you probably don't need to dump a whole lot of money into small stocks. If you already have enough money for your needs and you don't care about growing it a bunch, you can put it in more stable things that just generate yield. It's totally fine to let your emotions help with the decision of what your asset allocations are going to be, what stocks you're going to get in. That's totally fine. And I love to emphasize that because my expertise or my data or any of the historical stuff doesn't override who you are as a person. That doesn't just walk all over you. That is still incredibly important because if you have a person that can't really handle volatility, they're actually going to make that perform worse because they're going to trade out of things when they drop. They're going to buy into things as they go up. They're going to fall into the common pitfalls that every stock trader falls into when they start, and most people all the way through their careers, where they do the opposite of everything that you're supposed to do just because of emotions and because of fear. Fear is always one of the greatest drivers of failures in investing. And if you can push through your fear, then you can make a lot of really good decisions. But it's okay to know if that's not possible. It's okay to know that you aren't built for a certain thing. And possibly that's when to go into the conversation of looking for an advisor, for somebody to do it for you that knows what they're talking about, because then you can offload that emotional responsibility. So that brings us to our conclusion for the day.